Let's start with this PBOC line then. It seems that they're pushing back on the idea that they're going to be cutting the deposit rate. Does that change your view in any way about the equity space in China?
No, in brief, it doesn't. Today we increased our China overweight materially. It's by far our preferred market in emerging markets right now. I don't think monetary policy and things like deposit rate changes are as important as analyzing overall sovereign balance sheet strength, and in particular ability to deploy aggressive fiscal policy without encountering significant currency weakness. And in that regard, China is significantly stronger than the average EM.
Can you run us through, Jonathan, some of your forecasts for China's main indexes then?
Yeah, so we are cautious overall, and in terms of absolute returns upside, we see very limited upside to our base cases. However, in terms of risk-reward, we think China is much more favorably skewed than the average EM. So our CSI 300 target at the moment is 3870, which does give some modest upside from current levels. We are 23,500 as a target for Hang Seng, again, some modest upside. Whereas for broad EM, we have a base case target of 800, which has sort of low single-digit downside. Now, all of those are base case targets for year-end, but what we're emphasizing in terms of risk-reward skew is the risk-reward skew between bull and bear would favor the China indices over the broad EM indices. And that's not just because of the sovereign balance sheet point that I already made to you. It's also about things like the sector skew, sustainable yield, and ability to control COVID-19.
Jonathan, we've seen about 200 companies in China report. Earnings season pretty much wrapping up in Hong Kong now. Was there anything that stood out to you? Are you getting much visibility now?
The visibility is very low. Obviously, earnings estimates are starting to come down, but our aggregate earnings estimate for EM is around 25 percentage points below bottom-up consensus. So that's a very material difference in view. The last time I can remember being that much more bearish than consensus was at the end of 2008 and into early 2009, when we had a similar sudden dislocation in the global economy, obviously post-Lehman's, to what we're seeing now. So I think consensus estimates will have material further downside as we go through the earnings season and the outlook. That said, obviously, markets have moved a long way to the downside already, and valuations are certainly low. And that's why on the base cases we get that sort of upside and downside that isn't that large relative to where we're trading now. But certainly we think that this is not an environment where investors should be in any sense getting aggressive and buying these markets.
And in terms of Morgan Stanley, it seems like your house also upgrading Hong Kong, Malaysia equities as well. Tell us a little bit more about the rationale. In terms of Malaysia, I mean, have you actually priced in this potential growth shock that we've seen, given that we just saw the government slash their growth forecast for 2020 to a possible contraction now?
So those upgrades you mentioned are for MSCI Hong Kong and MSCI Malaysia. MSCI Hong Kong is obviously a different universe from the Hang Seng, where I just gave you the index target. We were underweight those, and now they're equal weight. Within the ASEAN universe, our overweight is Singapore, which again comes back to that point around sovereign balance sheet strength, and in that case in particular actually sustainable yield as well as ability to control COVID-19. So Singapore is our preferred market in ASEAN.
Jonathan, can you run us through some of your sector preferences and the rationale for them?
Yeah, so we've recently published a piece on our highest conviction stocks to own in Asia ex-Japan and emerging markets, and also in China. When we look at the sector skew there, it is skewed to information technology, communication services, and materials. So that's what makes up the majority of the stocks that we hold.
And is this about looking for quality versus value or growth stocks? Is this a time where you want to be stress testing companies' balance sheets?
Well, certainly we did do that analysis. I think, again, it comes back to the sustainability of yield, and dividends obviously are very much in focus as one of the drivers of equity performance right now, with the dividend cutting that we're seeing in Europe in particular, something my European colleagues have been writing about. But really what we're looking at here is, are the business models robust in the shape of the global economy that we see in front of us right now? So we have, for example, names like China Mobile, Alibaba, Tencent amongst those stocks that we hold. But outside of China are TSMC, for instance, or Samsung Electronics. And those are stocks where we think our analysts were arguing that the stocks were reasonably priced going into this and are now significantly cheap versus their sort of base case views. I think the materials sector is also worth a quick comment on. We're recommending gold exposure here. So obviously the enormous stimulus we're getting from global central banks will expand global money supply. Again, coming out of the 2009 and 10 event, the gold price did very well. So a name like Zhaojin Mining in China is one that we're recommending here. And if we look at elsewhere in materials, I think it's important to understand that, again, infrastructure spending, not just in China, but more general infrastructure spending, including in the healthcare sector, will be an important driver for a name like BHP Group in Australia. And we also have Anhui Conch in China itself. So I think if you have a portfolio that's constructed around information technology, communication services and materials, that will serve you better than having, for example, significant positions in upstream energy, industrials, capital goods, traditional consumer discretionary areas like automobiles.